Something that many retirees don't know until it's too late is that your Social Security benefits can be taxed. In fact, up to 85% of your benefits can be included in your taxable income, depending on how much other income you have. And what's worse, the thresholds that determine this haven't been adjusted for inflation since 1984. So more and more retirees are paying tax on benefits that were never really meant to be taxed for most people. In this video, I'll explain exactly how Social Security taxation works, what causes it, and how you can manage your income to avoid or reduce this tax trap in retirement. I'm Kerry Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. Okay, let's get into it. To understand how this works, you need to know something called your combined income. This is the formula the IRS uses to determine how much of your Social Security gets taxed. So here's how it's calculated. You take your adjusted gross income, that includes things like IRA withdrawals, pension income, dividends, and capital gains, and you add any tax-exempt interest, like municipal bonds, and then you add half of your Social Security benefits. That total is your combined income, and once it crosses certain thresholds, a portion of your Social Security becomes taxable. For single filers, if your combined income is between $25,000 and $34,000, up to 50% of your Social Security is taxable. Above $34,000, up to 85% is taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000. And remember, these thresholds are not indexed to inflation. So that means more people cross into the taxable range each year, even if their purchasing power hasn't increased. Now, let's be clear, you're not paying an 85% tax rate. What it means is that up to 85% of your benefits are included in your taxable income. So if you're in the 12% federal income bracket and 85% of your $30,000 in Social Security benefits are taxable, that adds $25,500 to your taxable income. And then you pay 12% on that portion. But it gets trickier. The way the tax phases in creates a situation called the tax torpedo. This happens when additional income, like taking money out of an IRA, causes not just that income to be taxed, but also causes more of your Social Security to become taxable. That means your marginal tax rate, the rate on your next dollar of income, could be much higher than your actual tax bracket. In some cases, retirees in the 12% federal bracket could effectively pay 22% or 27% or even 46% on their next dollar of income due to the torpedo effect. So where does the risk of getting hit with this come from? It's not your Social Security check. It's your other income sources, traditional IRA withdrawals, pension income, capital gains, even dividends from a brokerage account. They all count. Even Roth conversions, if done without planning, can inadvertently trigger more of your Social Security benefits to be taxed. And it's not just a tax issue. Higher income can also push you over the IRMAA thresholds. Those are the income levels that determine if you'll pay more for Medicare Part B and Part D. So one poorly timed withdrawal or Roth conversion can affect both your tax bill and your Medicare premiums. Now, most people assume that Social Security isn't taxed, or if it is, that it's only for very high-income retirees. But that's just not true, because the thresholds are so low. Again, $25,000 single or $32,000 joint. Even modest income retirees can end up paying tax on most of their benefits. And since these thresholds haven't changed in over 40 years, more and more people are getting caught in this trap, especially as pensions, RMDs, and investment income stack up. It's not uncommon for someone who worked hard, saved diligently, and now lives on $60,000 or $70,000 a year in retirement to find that 85% of their Social Security is taxable. Okay, so let's talk strategy. How do you avoid or minimize the tax? First, Roth income does not count toward combined income. So one of the most effective ways to lower your Social Security tax exposure is to draw income from Roth IRAs, Roth 401ks, or even cash savings. Second, managing the timing and amount of your withdrawals matters. For example, you might delay Social Security and live off of IRA withdrawals early, or the reverse. It depends on your bracket and goals. Third, consider partial Roth conversions, especially in the years before RMDs begin. Done carefully, this can reduce your future taxable income and limit how much of your Social Security is taxed. Fourth, you can use qualified charitable distributions, or QCDs for short. If you're age 70 and a half or older, these donations go directly from your IRA to a charity, bypassing your taxable income and reducing your AGI, and these also count as RMDs. And finally, coordinate your income sources. You may not be able to eliminate the tax entirely, but you can often reduce it with smart blending of pre-tax, Roth, and taxable income. So let's walk through a quick example. Imagine a retired couple with $40,000 in IRA withdrawals and $30,000 in Social Security benefits. Their combined income would be $40,000 plus half of their Social Security, so $15,000, totaling $55,000. That puts them well over the threshold, and that means up to 85% of their Social Security, or $25,500, would be included in their taxable income. Now suppose that same couple had done some Roth conversions earlier and only needed to withdraw $20,000 from their traditional IRA. Their combined income drops to $20,000 plus $15,000, or $35,000. Now only about 50% of their Social Security is taxable, and their overall tax bill is much lower. So the Social Security tax trap is real, but the good news is with a little bit of planning, you can reduce or avoid it altogether. The key is understanding how the formula works and how your other income interacts with your benefits. If you're not factoring Social Security taxation into your retirement plan, you could be leaving money on the table or paying more than you need to. So, if you want help building a retirement income strategy that makes sense for you, visit us at greenarrowfinancial.com or feel free to reach out to me anytime. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.